Welcome to the Credit Clubhouse podcast, a deep dive into the world of credit markets and alternative finance. Before jumping into our next episode, we have an exclusive offer for our listeners. Just head to dealcatalyst.io, pick any event, and then enter the promo code CREDIT at checkout. This will provide you 10% off any ticket to any conference. This offer is limited to the first 50 ticket buyers. Don't forget, we want you to follow the show, rate us, and leave a review. We encourage your feedback, and we want to hear from you, the listener. The next episode is presented by 9fin. Every day, you're making decisions that matter. Which credit to buy, which deal to pitch, which covenant terms will hold. You need the right intelligence, you need it fast, and you need to trust it. That's where 9fin comes in. One AI-powered platform with complete visibility across public, private, and distressed credit, built for how credit teams actually work. Head to www.9fin.com/demo to request a 30-minute personalized demonstration. Again, that is www.9fin.com/demo. And now, on to our next episode. Welcome back to the latest episode of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at Deal Catalyst. Joining me today is Patrick Turner, Partner and Senior Managing Director at VSS Capital Partners. Patrick, it's lovely to meet you virtually at least. Thank you for your time. I'm really looking forward to our conversation.
Me too. Thanks so much, Todd.
So for those who might not be, as familiar, with VSS, can you maybe give us a little background and how would you describe the structured capital strategy at VSS Capital Partners?
Okay, sure. Yeah. I'm just going to start off one thing though, because some of your viewers might be confused. English accent, English person, but I've lived in the US 42 years, so I've actually never worked outside the UK, out of the US, other than, visiting clients and so on. But so just so that your audience knows, I'm not living in London, I'm living in New York.
No problem.
So VSS Capital Partners is a long and good history. The long and good history that it was used to be called Ronis or Stevenson, which is a very well-known media buyout firm going back to the 80s. And then in the early 2000s, Jeff Stevenson, who's the last S of the VSS, decided to pivot a bit away from buyouts to providing capital on a minority basis, in other words, not a change of control, to founders that were looking for capital and also, perhaps more, just as importantly, help to take them to a different level in terms of an institutional grade type company as opposed to a young entrepreneurial company. So that's essentially what it is. Structured capital is a good way to talk about it. There's lots of people who have different ideas about what that means. But for us, it means a combination of debt and preferred equity that we provide to these founders in relatively small companies and hope to take them to triple the size in terms of EBITDA and really transform them into very, very interesting platforms.
So when I was doing the research on this, a term that kept coming up is full balance sheet solutions. From a practical standpoint, if I'm an entrepreneur sitting across from you on the other side of the table, what does that look like in practice?
Well, I think what that really means is that we provide capital as the whole of the liability side of the balance sheet. So, for instance, we can do senior debt, we can do sub debt, we can do preferred, and occasionally we can do equity as well. So it's really, when I say full balance sheet solutions, is we can provide all of those categories that would fit into that liability section. And so, if they're looking for a small amount of capital, maybe we start with some preferred or we start with some senior debt, and then we can morph into a much larger facility with these extra bells and whistles. So that's what I think it means, full balance sheet solution.
So, when you partner with, and part of your partnership certainly emphasizes partnership with founders, how do you balance, the credit discipline versus value creation? And then as a kind of a secondary piece to that, how are founders approaching capital today, maybe from, 5 years ago, 10 years ago? Are they approaching it differently?
So that's a really super question, and I think there's two questions, right? So the first one um, is in terms of credit versus growth. The whole idea of this is to protect the downside for our investors, but really focus on helping these founders grow significantly. And when I mean significantly, I mean like 100% revenues and maybe 300% in terms of profit. So the focus in terms, because we have ownership in the firms, in the companies themselves, we're looking to maximize that equity. The credit side has a lot of covenants associated, is a classic credit package, but we're really not focused on that so much as on creating this, growth that I've talked about. Hence, when we say, I think on our first page, VSS Capital Partners, a growth capital partner, as opposed to a credit partner. And I think that's the big difference between us and a number of players in the market, particularly 95% of the credit in the market is to sponsor transactions. We
Mm-hmm.
are essentially the sponsors, and that's why I was talking about the PE background that we had, that we can bring into these situations very credibly, and really help these founders, grow to a completely different level.
The second piece to that, how are founders approaching capital today, maybe compared to 5, 10 years ago? And have you started to see some of the current market conditions change anything, in terms of conversations that you're having today?
100%. I mean, I think 10, 15 years ago, most people did not know that there was an alternative solution to being bought out. So, the classic situation for us is a founder gets approached by some banks. The banks say, we can sell your company for a whopping great price. They say, okay, that sounds really interesting because I've sort of reached my limit in terms of what I can do myself. And then they think, well, actually, I don't really want to sell majority. I'd like to keep majority of the company myself and find someone who can take me to a different level. And so that really didn't exist 15 years ago. I think there were some growth capital players, of course, well known, but very highly dilutive, maybe even diluted to the point of exchange of control. Whereas our solution, which is a combination of debt and equity, means we don't need so much equity to provide the returns we're looking for. And I think, as you say, the market has changed really significantly in the last few years. 2021 was the sort of heyday of buyout activity. Buyout activity in a slow growth, inflation-oriented economy has been, very, very low comparative to the past, maybe a quarter of what it was in 2021. So deals are getting harder to sell. People are doing more due diligence. And I think multiples as well are being looked at very carefully. So that world has really had an effect on people wanting to sell change of control because they were hoping for a big payday. They're just not getting that. I think people are much more disciplined these days, particularly, you've seen this, but only the top rated funds can actually raise money these days.
Yeah.
There's been very, very few distributions. There have been very, very few sales other than continuation vehicles. And so I do think the market's changed. And I think it's changed very much sort of in our favor in the sense of more activity on the minority basis. But I just think generally it's changed quite a lot. If you talk to some investment banks, they'll tell you that, about a third of their mandates don't get sold, some more,
Mm-hmm.
which is really interesting.
So, one part of the market that I think is, certainly shown a bit more resilient has been the lower middle market. Why do you think that continues to perform and show more resilience than maybe other segments in the market?
Well, let's look at the bad side of this. So if you talk to institutional investors, they say they do not like the upper end of the market. The PE upper end is an area they don't want to go because that has typically been one that uses leverage, significant leverage, to get returns.
Mm-hmm.
And then with the interest rates going up, actually doubling over the last few years, that's really been a very difficult place to make money. And margins have shrunk. They don't get the same multiples as they bought into, et cetera, et cetera. So you'll find that institutional investors now prefer the lower middle market because there's more opportunity to grow. You can grow in a sort of flattish to even downish environment because of acquisitions you can make and clever things you can do to help these companies grow to a point where you want to get them to get to. So I think that's why sort of the buy and build strategy and alpha that's created by that is really the difference between making money now for your investors and not. And so the big P firms, big deals hard to grow. and particularly in this environment. So I think that's really where you want to avoid, and people are avoiding. I think people are also avoiding the credit markets generally because of some of the problems that exist in the economy. So it's very interesting. I think lower middle market PE is where you sort of want to be, and where you're finding the most interest from investors. And we just happen to be a hybrid, as I think you well said earlier, is we're a hybrid where we protect the downside, but we're looking for PE style returns. So it's really interesting.
And have you started to see some of the investors who might traditionally focus on the upper market move down? And does that create either, more opportunity for someone like VSS or more risk? I mean, how does that dynamic start to play out?
Yeah, no, super interesting. I guess the answer is yes. I think you see some very large state pension funds really looking at this category quite a lot more closely. Some, in fact, have actually created a bucket within their portfolio for structured capital. But as I said earlier, there's a different varieties of structured capital. In particular, the larger funds that have been raised are typically really looking at preferred stock and going for 2 times type return. Um, and that's sort of a different style of the market than where we're playing at. So is it of concern? No, I don't think so. I just think the style of investing will change. And some of these bigger funds will be very effective. They fill a hole that's necessary. And I think that's where most of the big players will go. People like us, we're sort of small for a very large state pension fund, but nevertheless quite interesting. But nevertheless, and I don't think many people like to invest in strategies that aren't the primary strategy of the private equity firm. And most private firms are focused on pure out control. So if they have a fund like ours, it's very much second fiddle, and investors don't like being second fiddle. So
Are there any particular sectors within the lower middle market where, you're seeing particularly, strong or really interesting opportunities today?
well, we focus on three main end markets, which is healthcare IT, education IT, and tech-enabled outsourced business services. And I always maintain that the last two are growing, are very large, and provide for are very fragmented as well, with some unique opportunities, and particularly the outsourced business services, because in a, as I say, low growth inflation environment, what do you want to do? You want to cut costs,
Hmm.
so you want to outsource as much as you can. I think the big question today is AI and how it's going to
Yep.
affect those type of businesses, and it's definitely horses for courses, but it's something you need to pay attention to very carefully. And so, is that risk? Is that opportunity? I think it's both. It's both.
And are you getting, particularly on the AI piece, are you getting more questions, more inquiries from LPs or, you know, what could this mean? I'm seeing all these headlines. How are you guys protected or how are we protected given that we're partners in your fund? Or how does that dynamic work in an environment today, which is obviously getting lots and lots of headlines, not all good, by the way.
No, listen, 100%. I think eh, eh, you know, any sophisticated investor is going to be asking you about this and how you're attacking it and how you're approaching it. And it becomes sort of a bit of a headline. And I think it's appropriate. It's very appropriate to do that. You could be scared of it. So what? You still got to address it.
So we've seen direct lending obviously grow dramatically over the past decade, not having the greatest of moments in the last few months, or say last 6 to 8 months. But where would you say structured capital fits within the broader ecosystem if you start to bring in some of these other strategies?
So it's that's a really good question. And I talked about the larger structured capital funds being raised. There's several out there. Um, that's where they can plug the hole when there's a problem in a deal that can be satisfied through outside capital coming in at a reasonable basis. And
Hmm.
it's different. So I think P is looking for the high return. So structured capital is sort of looking for much more of a risk adjusted return that's safer. So I think there's a role for that for the strategy within these larger deals for sure. We recently actually saw some to plug a hole in one of our companies because it was growing so fast. So I think that's going to be that's very real, and I would see that expanding, for sure. Um, at our end of the market, the lower end of the middle market is, I don't really think it's that. It's certainly not a, that is not a solution at that level of the market, because you can't put too much leverage on these companies. So it doesn't become really a solution. And then there's other issues regarding size of companies and whether certain funds are capable of managing them if they hit a bump on the road or whatever, which is, really critical. And so you'll see in downtimes, you'll see a lot of people run away from the market, actually, and then very few people will be coming back for quite some time. So it's a little bit of a different set of situations there, small versus large.
And in terms of, when things get more choppy, I mean, you alluded to it, things get a bit trickier. Is that where structured, capital strategies might become even more relevant as the market becomes more uncertain?
100%. 100%. None of us really like to go into companies that have a falling knife. So, that's the danger of that. But, certainly over leveraging, bringing it back to a reasonable leverage level is a solution that our product can provide. And I think, certain situations could be very attractive.
Especially in an environment like today where you get some of the over leverage on the upper end of the market where you're seeing a lot of the headlines ultimately coming from.
100%. Absolutely right.
In terms of interest rates, macro uncertainty, obviously we have, some of the stuff we've been talking about here. There's still a war going on. How do you think that influences, or does it influence, the way that deals are structured? And, maybe talk a little bit more about some of the other factors in the market that might go into how things are structured for a deal that you might work on.
Well, I think that, when you go into a deal, you do a base case, right? And your assumptions are X, Y, and Z. But the X, Y, and Z includes growth potential within the company. And that will determine often, how much you can give them, what the valuation of the company really is, etc. And that's really determined by, potential growth. Now, these outside events, like you talk about tariffs, now the war, all have a negative effect on growth. And I think there's a danger often that people confuse these outside macro forces with being recessionary. And once you get into that zone, then people stop investing because you can't be investing in a down market, let's say, unless you're really well compensated. But I doubt that. So I think you need to pick apart what the real levers are for the companies to grow, whether they are insulated, whether they're not insulated, and where the opportunities lie, irrespective of where the world is and what decisions are being made outside of your control.
Yeah, you touched a little bit on the investor or LP perspective before. Are you seeing different types of LPs start to become more interested in the structured capital strategies that you guys have, and are the questions they're asking, how big is maybe the education gap with LPs on maybe I've been allocated to direct lending, I want to start looking at different strategies. How different can it be? Like, how big might the education gap be?
No, very good question. I'll tell you an interesting story. So I went to Japan to pitch the fund, a couple of years ago, and the fellow who was the CIO, I guess, always said, "I really like what you're doing, but I have no idea how to explain it to my superiors." So, there is an element to that, and I think, golly, the larger pension funds have so much money to invest that a fund like ours is just way too small. They want to put in 300, 500 million per ticket, and so that's why they veer towards these more conventional strategies like private credit or even traditional PE. And if you do that, you're going to get ordinary returns. You just are. So what are ordinary returns? Probably double digit below ones, and that's why you see sometimes what you're seeing today in credit with a huge run up in volume. That all it's having the effect on is compressing margins and creating tremendous competition between all these funds. So I think where the real difference from a few years ago is the family office system. And the family office system is really interested in the structured capital approach because, of course, they were entrepreneurs once, so they
Hmm.
totally understand the playbook. They wish they had been around when they were there at the same time, often. And they really appreciate the downside protection because they're really not interested in losing capital. And they would prefer to sacrifice, some upside to having safety of capital. So I think that's where the big change is in the market from many years ago. And of course, there's been tremendous wealth created as well. So they're all, and it's not just in the US, by the way, it's all over the world. So I think that's the big difference that I see in the institutional base. I also see, more activity in the Middle East, for instance, which never really like to invest other than
Yeah.
the big, 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 big funds.
Hmm.
I see them being much more opportunistic. And, I certainly see the situation where no one's seen anything like what we do before. And that becomes interesting because as long as we can generate those returns and provide this type of solution, it becomes really interesting. They have nothing like that in their portfolio.
Hmm. When it comes to, obviously different market cycles, how important is it to, kind of manage with a consistency of strategy versus maybe, hey, I'm going to ebb with here and, kind of jump over here. It feels like there's some in the market that are very much go with where the flow is going. How important is it for you and your investors, obviously, to stick with the strategy that you're good at?
Well, you always got to have your antenna up for recessionary, impacts. There's not one company in the world, maybe Apple perhaps, that doesn't get affected by, recession of some sort, even though it
Yeah.
might not. So you always got to keep your antenna up. The and just avoid the commodity companies. We don't really invest in manufacturing or distribution, which tend to be a bit more commodity oriented. And so stick, as you say, stick to your knitting in terms of the types of businesses and what drives them and why they're going to be successful, et cetera, is really, really the key, irrespective of the overall environment. And listen, you should be ready to face some challenges in all these deals, but hopefully you structure them in a way where you can, manage yourself through it. So I think that's really important.
So we have one more question before we have some fun questions and we wrap up. What excites you most about kind of where structured capital solutions are going?
Well, you know what's interesting, Todd, is I've never been happier actually in a job, if you can believe it, after all these years of doing this type of business. Mainly because of the satisfaction you get from, these founders really achieving their goals and you helping them to do so. And there's lots of levers we bring to the table. There's outside people we put on the board, etc., who can be really helpful, and they themselves get excited about it. So, there's a real, I don't know. There's a conviction, of course, you've got to be convinced, but it's more this sort of fun to see, really, really good results. Obviously, it's not so great if you don't get a good result, but you're really trying to, if you've got a playbook that's quite a good one, you might as well stick with it, and that's what we've
Hmm.
been doing. So I've never been more excited. I like very much where we fit in terms of the lower end of the market. I've always invested in the lower end of the market, other than a brief time when I was at TCW Crescent, and I like it much better because you can understand them, these companies, a lot better. You can get under the hood and really understand what drives them and what can help to drive them more. So I think it's a super area, and I don't think it's going to go away. I think it's going to be around for some time. You'll see players come into the market um, in different ways. Maybe it's different end markets, maybe it's the same. I don't know. But again, if this is your main strategy, you could do quite well here.
So we have just a couple minutes left. I like to end with a little more fun. So do you have a favorite sports team and or hobby?
Well, I have a couple of favorite sports teams, as a matter of fact. Um, one will surprise you, and one won't probably. So my favorite soccer team, which English people we follow soccer, and we call it football, is Manchester City. And my favorite rugby team, which I used to play myself, is the English rugby team. So
Definitely not too big surprises there.
uh,
Tell us one surprising thing about yourself, though.
yes, so I think I was sort of thinking about this, and I think one thing which I think you will be surprised about, and many would be, is when I was born, my parents lived inside Windsor Castle. and I was actually christened in St. George's Chapel, which is where Meghan and Harry were married.
That's definitely good for dinner parties.
Yeah, that's a good one.
One book you'd recommend reading.
Yeah, so my favorite book, which I've given to many people when they have big birthdays, is Winston Churchill's *The History of English Peoples*, which is fascinating. Also covers, by the way, the emerging country called America back about 100 years ago. And so
Which now
really,
you've been here for so long.
yeah, it's really, really, it's a wonderful book. It really covers from, day zero, basically, in the UK onwards through until the emergence of the USA. So it's a fabulous book.
Just as a quick aside, when you first came to the US, would you have imagined that 42 years later that you'd still be here?
Such a good question. Most of the people I came over with, again, we came over on training programs, went back. And the reason they went back is because their family was, in the UK. My family has always lived all over the place. And so I didn't really have I mean, even though I'm English, I don't really have like a mandatory affinity to be there. So,
Hmm.
I like change. I think USA has always got, it's the most amazing country in terms of reinventing itself, new businesses, etc. That once I got addicted to that, I wasn't going to go back. I do go back regularly to see my family, but I can't tell you that I want to live there.
I mean, I presume to know the next part of your question because you referenced it a little bit, but for clarity purposes, the most exciting part of your job.
The most exciting part of my job is both the beginning, when you get introduced to a manager or a founder, and get excited about the prospects. And then, of course, you go through due diligence and hopefully you get to the table. So it's really, I maintain, it's sort of really interesting. I maintain that the importance of the founder is 80% of your decision to make to do the investment. People say, "Oh, it's the company that's more important." Actually, it's not. It's the person or people, and the business itself is almost secondary. But without the founder, there is no business. So
Yeah.
that's one of the things. And then the other exciting time, of course, is when you exit, and you can all celebrate a really a good job done. And I think those are the two most exciting times. Anyway, so I hope that answers it for you.
Yeah, for sure. Final question is one prediction for the next 12 months.
Wow.
Tricky time right now.
Super tricky. Prediction is, I think the political situation in the US is very fragile. And
To say the least.
right. And I think that, my prediction is will continue to be fragile for quite some time, which is what I think is the negative.
Yeah.
There's definitely no collusion between both parties. There's definitely everyone dislikes Trump who's not a Republican. It's just not the way to go as a country. We're all team players. We want the best. Well, apparently not. And so I hope for the best, but I keep getting disappointed.
You and me both. Well, Patrick, thank you very much for your time. It was great to learn a little bit more about you and obviously what you guys are doing at VSS. So continued success to you and the team, and hopefully we'll get you back sometime in the future.
Thanks, Todd. Really enjoyed it, and really enjoyed getting to know you and meeting you.
Yep, thank you. Thank you for listening to the Credit Clubhouse podcast. The Credit Clubhouse is brought to you by Deal Catalyst, the leading capital markets events and market intelligence company. For more information on Deal Catalyst events, surveys, and a whole lot more, please head to www.dealcatalyst.io. Thanks for listening. Until next time.